Now speaking, Bernie McCracken, Interim Chief Financial Officer. Lands' End released its first quarter 2023 earnings this morning, with Interim Chief Financial Officer Bernie McCracken and Chief Executive Officer Andrew McLean discussing the results on an earnings call. The company cautioned that actual results could differ from those discussed due to risks and uncertainties noted in their SEC filings. Non-GAAP measures were also discussed, and a reconciliation of these to GAAP measures can be found in the earnings release. After the prepared remarks, there was a question-and-answer session. Now speaking, Andrew McLean, Chief Executive Officer. Good morning, and thank you for joining us today. Lands' End reported strong first quarter results with revenue at the high end of expectations, $310 million, and adjusted EBITDA of $19.5 million, well exceeding guidance. The company is continuing to focus on strategic initiatives to deepen customer focus and enhance value for customers, employees, and shareholders. In particular, Lands' End swim business is up high single digits year-over-year and has the leading brand in the swim category, gaining market share. Additionally, the company is utilizing more targeted promotions, which has resulted in strong year-over-year margin performance. U.S. buyer files stabilize with flat growth, and the rebuy rates of active customers are improving. Lands' End is leveraging strong buyer data to better reach and cater to needs of existing customers and expand customer base. The company is also pursuing a licensing strategy that enables them to do what they do best and partner with others to leverage their own strengths. Moreover, Lands' End is focusing on driving terms, increasing freshness factor, and leveraging vendor relationships to reduce time to market. Finally, the company is experiencing positive results from their renewed focus on customers and core products, as well as newness in the assortment. Now speaking, Bernie McCracken, Interim Chief Financial Officer. During the first quarter, Lands' End reported total revenue of $310 million, an increase of 2% compared to last year. Revenue from U.S. e-commerce rose 2%, while Europe e-commerce sales decreased 29%. Globally, e-commerce sales were down 7% or 4% when adjusting for Japan. Revenue from Lands' End Outfitters increased 37%, excluding an $18 million difference in year-over-year revenue from Delta. Third-party business revenue increased 6%. Retail store revenue was $10 million, with U.S. same-store sales increasing 9.5%. Gross margin improved to 45%, a 210 basis point improvement from 2022. SG&A as a percentage of sales was flat to 2022. Net loss for the quarter was $1.7 million or 5 cents per share, compared to a net loss of $2.4 million or 7 cents per share in 2022. Adjusted EBITDA increased 41% to $19.5 million and exceeded the higher end of expectations. Inventories at the end of the quarter were $376 million, a 14% decrease from last year due to leveraging supply chain and transit times. At the end of the first quarter, term loan balance was $241 million and $275 million. ABL had $100 million of borrowings outstanding, which was $25 million lower than last year. The company repurchased $3.8 million worth of shares under its $50 million share repurchase authorization. For the second quarter, they expect net revenue to be between $320 million and $335 million, a net loss of $4.5 million to $2 million, and diluted loss per share to be between 14 cents and 6 cents. They also expect adjusted EBITDA to be in the range of $15 million to $18 million. Full-year guidance incorporates approximately $35 million in capital expenditures and net revenue of $1.56 billion to $1.62 billion. Net income of a net loss of $4.5 million to net income of $2.5 million, and diluted loss per share of 13 cents to earnings per share of 8 cents. Adjusted EBITDA is expected to be in the range of $75 million to $84 million. Now speaking, Andrew McLean, Chief Executive Officer. Lands' End is taking aggressive and achievable steps to improve the business, grow, and improve profitability. The company has recently hired a new Senior Vice President and General Manager of Lands' End Outfitters and SVP U.S. e-commerce with 20 years of industry experience from Nike and McKinsey. The company plans to innovate their product strategy, customer engagement, and internal approach. These changes are intended to help them build on and stay true to the Lands' End history and brand, while providing updates about how this work will benefit customers, employees, and shareholders. Telsey Advisory Group analyst Dana Telsey inquired, "What progress have you seen in swim and vacation-related apparel? What has been the greatest growth from your marketplace initiative, and what are the margins? How are inventory levels and promotional landscape looking for the rest of the year?" Andrew McLean replied, "Thank you, Dana. We took a view coming into the quarter that our leading market share was best defended and attacked by starting earlier and running longer with product through our supply chain. This enabled us to react to trends quickly. Our data gave us insight into an extended swim season, and we expect vacation to evolve in the back half of the year with strong ownership in outerwear, knit bottoms and beyond. Our marketplace strategy continues to please us, as we are able to offer customers a different profile on each platform and leverage our inventory across them. Margins for Lands' End Fulfill continue to be strong. Bernie McCracken replied, "Thanks, Andrew. We have seen stabilization in our transportation of inventory and taken advantage of this to keep our inventories down mid-double digits, around the 15% range. We found strength in introducing new products with higher margins, while still needing to discount some products to liquidate inventory. We feel confident that inventory levels will remain at normalized levels for the rest of the year." Andrew McLean replied, "Dana, our goal is to drive higher turnover and ensure our products remain fresh. We have a long history of cataloging, which has seen us introduce large amounts of inventory at the start of each season and let it run down as the season progresses. Going forward, we will be introducing inventory in smaller batches and more closely matching it to our revenue streams. This will bring a number of advantages, including improved cash flow, greater freshness and lower markdowns. These changes will be reflected in our margins and turns, resulting in a more efficient business." Telsey Advisory Group analyst Dana Telsey inquired, "What was the main driver of the better-than-expected adjusted EBITDA uptick from the previous guidance, and how do we unpack that in terms of levers?" Bernie McCracken replied, "Dana, our gross margin has been the main driver of our success. Transportation costs have decreased throughout the industry, and we have seen a reduction in average unit cost of our product, which is helping us to maintain lower costs and make sure they are available at opportune times." Andrew McLean replied, "We are seeing significant benefits as our inventory decreases while our costs remain steady. This creates a tailwind of opportunity that will benefit us in the long term." Craig-Hallum Capital Group analyst Alex Furman inquired, "What have you noticed regarding basket size or customer acquisition costs that indicate the strength of your guidance for the year?" Andrew McLean replied, "Overall, Alex, it's been a steady but choppy ride. We're being more thoughtful about how to reach our customers across various channels such as Macy's, Target, Amazon and landsend.com. For example, we've seen a 10% lift in our Instagram followers since making the site shoppable. We view these channels as one digital enterprise rather than silos and are leveraging that across the business. This, combined with what we discussed earlier, gives us momentum as we move through the rest of the year." Craig-Hallum Capital Group analyst Alex Furman inquired, "Andrew, can you provide an update on the progress of licensing talks and what categories you are considering?" Andrew McLean replied, "It's essential for us to stay true to our heritage as a family variety retailer. We've allocated $1.6 billion to spread across a range of categories and geographies, which allows us to remain competitive. Licensing also provides an opportunity to invest in areas where we can stand out and differentiate ourselves, such as swimwear or outerwear. We're utilizing partners to enter new markets like Latin America and the Middle East where we don't have the experience to go in on our own. Partnering with others enables us to build our margins, expand our reach, and capture demand quickly." Craig-Hallum Capital Group analyst Alex Furman inquired, "What strategies do you have in place to ensure that this growth continues and that the company meets its financial objectives for the rest of the year?"